Good afternoon. Good afternoon. Hello and welcome to the 794th meeting of the Economic Club of New York. I'm Dambisa Moyo, the Vice Chair of the club, Global Economist, and Co-Principal at Versaca Investments, a family-owned office. It is a pleasure to be here with you all. Before we begin, I would like to extend a warm welcome to the students joining us virtually from Fordham, Rutgers, and Mercy University, as well as to members of the 2025 class of fellows, a select group of diverse, rising next generation business thought leaders. The Economic Club of New York is proud to stand as the nation's leading nonpartisan platform for discussion on economic, social, and political matters. For more than 1 century, the Economic Club of New York has been a platform for thought leadership and dialogue. Today, we are privileged to continue that tradition with our distinguished guest, Jonathan Gray. Jonathan Gray, known to many as John, is the President and Chief Operating Officer of Blackstone and a member of its board of directors. He plays a key role on the firm's management committee and serves on most of its investment committees. Before stepping into his current role, John was the global head of real estate, where he was instrumental in building what is now the world's largest commercial real estate platform. His journey with Blackstone began in 1992, and over the years, he has been a driving force behind the firm's growth and success. Beyond his leadership at Blackstone, John serves as chairman of the board of Hilton Worldwide and sits on the boards of Corebridge Financial and Harlem Village Academies. Together with his wife, Mindy, he has made a significant impact in philanthropy. They established the Basso Center for BRCA at the University of Pennsylvania School of Medicine, dedicated to the prevention and treatment of genetically driven diseases and cancers. In partnership with the City of New York, they also founded New York City Kids Rise, a program aimed at helping low-income children build college savings from an early age. John is a graduate of the University of Pennsylvania, where he earned a Bachelor of Science in Economics from the Wharton School and a Bachelor of Arts in English from the College of Arts and Sciences. Today's program will be a fireside chat, and we are honored to have club member and anchor of Bloomberg's Wall Street Week, David Westin, as our moderator. As a reminder, this discussion is on the record, and we will end promptly at 1 p.m. Now, without further ado, please join me in welcoming John Gray and David Westin.
Okay, thank you very much for the introduction. I must say, I don't know how Blackstone's doing, but you can turn out a crowd. Congratulations,
The
John.
tickets must have been free.
Thank you so much for doing this. It's a treat always to spend time with you. So let's start with the news, more or less. We heard from the chair of the Federal Reserve yesterday, who included some projections for the economy. And at least what I took away from it is higher inflation, lower growth, but a lot of uncertainty. He was uncertainty, I don't know how many times in that news conference. How do you see it? Does he have it right?
Well, I guess certainly the backdrop is difficult to forecast. There's a lot of volatility given all the policy changes. But I'd start with the economy, and I'd say there we ended the year with our businesses with pretty good strength. Revenue growth was high, defaults among our borrowers low. So we went into the year, I'd say, in a good spot. We have begun to see some pockets of weakness. No surprise, the number of Canadian travelers coming to the US. Businesses that have some portion of their revenue that comes from government spending, feeling some pressure. Companies in the supply chain, uncertain about the tariffs and so forth. Capital markets related businesses, obviously financial services, have seen a pullback given the market volatility. So there's, I'd say, an overall pretty good picture in terms of employment and good momentum, but we are seeing a little bit of a slowdown here. I'd say the positive is that I think the inflation has continued to steadily decline. Maybe not as fast as it was a year ago, but if you look, the Fed has taken inflation from 9 at its peak, now down to 2.8. And if you look at CPI, ex shelter costs, where the government data lags versus what we see in our rental housing portfolio, it's at 2%. They basically hit their target. So it's possible we get a one-time shock with the tariffs, but I think overall the Fed will have some room to lower rates. So if it turns out all of these policy changes lead to more of a slowdown, then I think we'll see a little more of a cushion from the Fed lowering rates. So that's helpful. The other things I'd say that, I'm sort of an optimist by nature, thinking about the glass half full here, is I think the change in regulatory environment will be helpful for businesses, certainly in the M&A area. And then I think the most important thing to not lose sight of as investors is what's happening in technology and how this AI, I think, will impact the productivity of companies and therefore their potential earnings over time. So I think near-term short answer, a fair amount of volatility, maybe some slowdown given what's happening, but probably a better prognosis as we look out over time.
So there are at least two issues, it seems to me right now. One is the policies, what they are, and some of them we have a sense of, some of which we don't yet. But another is just not knowing. How much of a drag is there on the economy at this point of businesses, CEOs, just not knowing, and so they'd rather not move anywhere? Sort of, I would say, the way Jay Powell did yesterday, said, we're not going anywhere right now.
Well, I think it depends how long it lasts. So one of the things about this tariff diplomacy in particular is we see these things can change pretty quickly, right? I think this morning the Europeans said they're delaying what they're going to do with whiskey tariffs, so forth. And, this is dynamic. And so I think it really depends ultimately on where things settle. Because I think other governments will react to policy moves by the US, and there'll probably be negotiations, and where these things settle may be at a better place than where they start. But in the interim, it does create a higher level of uncertainty. It does make market participants more hesitant, and so there is some drag from it. But again, I think as investors, you want to take a little bit of a longer term approach, and I think you can have an expectation that a number of these things will ultimately settle, and then we can find sort of terra firma.
We've heard from President Trump himself, as well as from the Treasury Secretary, Scott Bessent, here at the Economic Club of New York, that in fact, there's going to be some pain. There's going to be some dislocation in the economy. Is the game worth the candle? I mean, is it worth going through that right now? Even the possibility, there is a possibility of recession. Jay Powell talked about it. Is the pot of gold that big at the end of this?
Well, I think what's interesting is there's actually pretty broad-based, I think, consensus around a number of things they're trying to achieve. So I think most people would agree that running 7% deficits of GDP, that's not a sustainable thing. So we've got to look at that. I think there would be a consensus that if another country's market should be relatively similar in terms of its openness for receiving investment from us or receiving our goods. That spending globally amongst our allies on defense should be at a relatively comparable level as a percentage of GDP. The US shouldn't just carry this burden on its own. And that some manufacturing should come back both for national security purposes to the US, but also to help low and middle income people. I think the debate is about the tactics, the speed, the scale, the impact on some of our closest allies, which is pretty profound, what's happening to some of our research institutions in the medical field. And again, I think we're going to have to wait and see where this stuff settles out. I think the administration probably will pivot on some of this. I think there'll be negotiations again. And I want to give this a little bit of time. But to me, it's not so much about the ends, but the means here. And are some things going too far, too fast? And obviously, the administration is going to have to make those calls.
So you started with deficit, which is on a lot of people's minds right now, whether we're doing something about it or not. At the same time, priority for the president is renewing the Tax Cuts and Jobs Act, which will actually make it worse in long-term projections. How much of the strength in the economy, and for investors right now, is the anticipation of that renewal? If that went away, how much damage would that do to the economy?
I think the market does expect that there'll be a tax deal at the end of the day, and I think that's a reasonable expectation. But I do think the bond market is obviously watching closely deficits. And so, again, there's a balance here, and it's pretty hard to predict. The question is, are valuations out of line, right? Is relative to the market. I think we went into the year with pretty high multiple stock prices, 22 times earnings. Bond spreads, both investment grade and high yield, were close to record tights, and there were very high expectations for what would come. So it's not a shock, I think, that we saw a bit of a pullback. Although at this point, interestingly, stock market, I think, is only off 3% or so from the beginning of the year. It's off more from its highs. So I would say, I think valuations generally are reasonable, given the environment, particularly given the progress made against inflation and the fact that I do think we'll see a little more easing. And I think it's realistic to assume some sort of tax deal gets done. And I think, you know, the US thinking about its deficit is important as well. But again, it is fluid.
So John, take all of that fairly nuanced, complicated view of the economy and put it into the machine you have of deciding how to invest at Blackstone. How does it affect your investment decisions right now?
Well, we try to take a longer term view. We certainly look at the level of prices. So I think what's interesting is in times of high uncertainty, generally prices are more attractive. It's counterintuitive. So when you're in 2000 or 2007 or 2021, there's extraordinarily high levels of confidence, and you're basically assuming all good things are going to happen. And that's when the risk is the highest. Today, when I look at most asset classes, particularly in the private market, there are very few transactions I look at and say, oh my gosh, I can't believe this asset's priced at this level. Maybe there are a few tech companies at very big valuations, or maybe there are certain pockets. But overall, when I look at borrowing costs in the private market, when I look at where commercial real estate sits today, when I look at the companies, I was at an investment committee earlier this morning, prices generally seem fairly reasonable. And I think it reflects the fact that people are collectively a little bit nervous. And so if you have a view that somehow we're going to get through this, that a bunch of this noise in the system will work its way out, and can I buy a good business at a reasonable valuation, then I'd be probably more inclined to lean in, even though we see a lot of things that make people nervous. And what tends to happen is, you know, they leave when the best opportunities exist, they come in when it feels very comfortable. And now just feels like a time where the nervousness is high and the pricing for assets is reasonable.
So take us into one of those investment committees. Share some secrets with us. What do you do? I mean, how do you evaluate potential investments and decide this one's a good one, this one we'd rather stay away from?
Well, it's definitely more of an art than a science, right? And you rely on obviously a lot of analytics, a lot of judgment, but also some gut. I spend my weekends reading investment committee memos. Other people do more fun things, I think. But I love the intellectual challenge of it. I love thinking about what makes a business good. And I'd say what we're trying to evaluate is a few things. Is this business in a good neighborhood? You know, you could be a landline phone company or legacy cable or a department store business where there's a lot of headwinds. Is this a business where there's really long-term strong tailwinds where this sector is going to grow a lot? Things like energy and power today, or data centers or other things. Does the business have a big addressable market? Can it grow? Does it have high margins versus low margins? High margin businesses tend to have a brand or some sort of moat about them that gives them a competitive advantage. And obviously they can absorb a shock much more than a low margin business. Is the business more capital intense versus less capital intense? We bought a number of franchising businesses. We owned Hilton in the past. More recently, we bought Jersey Mike's, which is a great sandwich business. We love franchising businesses because you're just getting royalties. You don't have the capital cost. So you like that. You like businesses with lots of customers versus one customer. You love businesses that have recurring revenues. Right? We used to have an M&A business at Blackstone. Every year we had to start over from scratch. Managing capital, we get recurring fees for doing that. So that has a lot of benefits. Do you have stroke of the pen risk? Are you building a business based on one government program that could change pretty quickly? And so you're looking at that, and then you're also looking at it in the context of the price you're paying. What do I have to believe in? And does the business also have a terrific management team? Do I have to take risk on the execution, or there's somebody great here who's running the business and so forth? And very few businesses check every box. And I could probably go through 10 other boxes. But you love to have a preponderance of good things where you say the price is reasonable, the business quality is really good, and the tailwinds in this neighborhood are really strong. And if you can buy enough of those, then your chances of success go up.
What about the box of geopolitical risk? Has that risen in priority in recent years? Because there's a lot more geopolitical uncertainty, I think, today than there has been in recent past.
Yeah, it definitely exists. And look, if you have an export-heavy business today into the United States, you know, I can say things about be patient and so forth, but if they're going to put a significant tariff, that's a real issue for your business. You know, when Russia invaded Ukraine and the cost of energy for a bunch of our European companies went up pretty dramatically, that existed. Some of the tensions, obviously, between the US and China over time have created issues. So I think you clearly have to look at that in the mix of where you're investing capital. Some businesses are more exposed, some less, but it's one of the factors you take into account. I would also say, you know, with emerging market countries, thinking about the currency risks, in particular, geopolitical stability. You know, we've seen in some of the Latin American countries a pretty sharp movement left, which sometimes is adverse, obviously, to businesses. So that's one more thing that goes into the mix when you're evaluating should you deploy capital.
Blackstone is a leader in deploying private capital, equity, and now credit, private credit. And I guess you weren't there at the very beginning, but you've been there a good long time now, over 30 years. Tell us about the evolution of private equity and now into credit.
Yeah. So the business in private capital was actually a pretty, I'd call it narrow business up till about 10 or so years ago. If you think about what we did, we invested in private equity, buying companies, private real estate, and distressed credit. And pretty much we were doing it all opportunistically. And you were doing it to produce high returns. The only people who would give you capital were sovereign wealth funds, pension funds, endowments, maybe some individual, very wealthy investors. But you got private capital because you could produce a 20% gross, call it 15% net return. And then the financial crisis came and interest rates fell. And we started talking to more investors about the benefits of private capital. And we started creating new structures to access different investors. And the idea was maybe you're not going to produce as high a return, but still a premium to what the public market does. So you start to think about core plus real estate, more stabilized, infrastructure, performing credit, both investment grade, non-investment grade. And maybe to an insurance client, if we can give them an extra 175 basis points of premium, that is very valuable to them if it's still an A- rated credit, but it's just in a private format. And so we also really led the way in creating a bunch of new structures to access individual investors. We and others moved towards servicing insurance clients. We started serving more institutions. And so the range of things we did grew a ton. And so the asset base has grown a lot. The thing I would say, though, what has not changed is ultimately it's about delivering great returns. So if you think of it like you run a pizza shop, you can have a great storefront and you can have good napkins and all that stuff's wonderful and the lighting and the music. But if the pizza doesn't taste good, it doesn't really matter. And in our business, no matter who we're serving, a pension fund, an insurance company, or an individual investor, at the end of the day, we have to deliver good performance. Back to spending a bunch of time reading these memos and so forth. But if you said, where are we on this journey of sort of the evolution of private capital, I still think we're in pretty early days. Because if you look at individual investors today, unlike institutions who are a third, call it, allocated to private assets, wealthy individuals are 1-2%. Insurance companies, again, low single digits other than commercial mortgages. And so I think you'll see this continue, again, so long as we deliver performance. And I think for the economy, it's obviously a very positive thing because now we have robust capital markets, we have robust public markets, and we have this robust private sector. And it's proven to be, I think, one of the great competitive advantages of our country.
So that sounds great, but has it gotten a lot harder? I mean, first of all, you have over $1.1 trillion to deploy. That's got to be harder to find places to put that than if you have 100 million. But secondly, there was a perception, which may have been unfair at the time, that in the early days, basically, you'd buy something, turn some leverage on it at low interest rates, basically, and then sell it. Maybe break it up, maybe sell it, maybe hold it 3, 4, 5 years, like that. It's not my perception that works anymore.
Well, I think the business has definitely evolved. A couple of things on the scale of the capital. Remember, a lot of the new capital we've raised has been in areas where they're big, broad markets. So if you think about it almost like a pyramid, the number of highest returnings, private equity, real estate private equity deals, that's probably a little more limited. But still, the stock market's grown a ton. And so I think the investable universe there is still pretty big. But the greatest growth in AUM has been in these lower returning, more perpetual, often yield-oriented strategies. And so the investment set in infrastructure or in credit or in stabilized real estate, these are enormous markets where I think the penetration is still early days. If it all had gone back to our original strategies, then I would agree with you. In terms of the business, and I think your comment relates as much, let's say, to original private equity than anything. I think there, it is not enough to just show up with capital to buy a company, right? You have to add value. You have to make sure you have the right management team. You have to make sure they're doing the right things with technology, give them advantage of purchasing, help them allocate their capital, maybe sell a non-core division, maybe reinvest and strengthen and speed some other area. You know, I mentioned Hilton earlier. We took a company that was, I would say, very sleepy, and Chris Nassetta, the CEO, did an extraordinary job transforming that business. And that's really what you have to do. I think the misperception of our business, which maybe it relates back to the 80s when it started, where you'd buy slow-growing industrial companies, it was about firing people. Today, it's actually about buying faster-growing businesses and accelerating that growth. How do I take Jersey Mike's from a great US business to make it a great global business? And so, yes, I would agree with the premise, it takes more, but the capabilities we're adding to these companies is materially different than what we had, say, 30 years ago.
The growth in private credit has been astronomical and just remarkable at Blackstone, but also others. There's some other big players in there. Why is it a better mousetrap? Why is it a better way of allocating capital for the economy overall than the alternatives in public?
Well, I wouldn't say it's better for everything, right? So if you look in investment grade corporates, if you're one of the biggest companies in the world, you can issue credit at a very low cost on a direct basis, basically to the market. And there, I think the public system's the best. When you get to other asset classes, there is an opportunity like direct lending, lending to private equity sponsors, or now increasingly in asset-based finance. What you're doing is you're bringing the underlying investors right up to the borrowers, and you're knocking out a bunch of financing, securitization, distribution costs, and you're allowing the investor to keep that. So if you think about asset-based finance today, a bank may have to make a loan, take on balance sheet risk, charge some fees, then do a securitization, then tranche it up, sell it around the world. And by the time the investor gets that underlying A- rated bond, there's been a lot of cost. So if we can go farm to table, then you can produce something that is a higher return to the investor. Now, they are trading away some liquidity. So you're not going to take 100% of somebody's fixed income book and do this. But can you take it from almost nothing today to a greater percentage? The other thing I'd comment on is, because there has been a lot of concern, does it create systemic risk, right? And what I would say about systemic risk in finance is it's basically two things. It's leverage and it's the duration of the leverage. So if you went back to the financial crisis, you had banks that were 40 times leveraged, right? You had large commercial finance companies that were massively leveraged. You had housing being bought with no equity. That's one big risk. The other big risk is this mismatch of duration. So if you think about First Republic, that bank that failed, it was $70 billion super prime mortgage book that had almost no defaults, 20-year duration, but the deposits, of course, could leave in 20 seconds. Now look at what we're doing in private credit. We're oftentimes lending unleveraged on behalf of our pension clients in direct lending. In our BDCs, we're less than 1 times leveraged. When we're lending on behalf of our insurance clients, they've got annuities or life insurance liabilities that are anywhere from 5 to 50 years. And so to me, it's really strengthening by deleveraging the system and also duration matching in a better way. Some of our competitors are becoming insurance companies and doing this themselves. We're just a third-party manager. But I think this is a very positive development. But I would say this, banks are really important because banks continue to do a lot of things we can't do. And we're partnering with a lot of these banks as they originate credit, and we can put it in terms of these long-term assets in the right places. So I see it as an incredibly positive thing for the system.
So you're persuasive in some really advantages, at least in some applications of private equity and private credit. I took psychology years and years and years ago when I was in college. The only thing I took out of it was the law of Tonstaffel, which is there ain't no such thing as a free lunch. What do you give up by going private?
Well, look, the trade-off for anyone who invests in private assets is you give up a CUSIP in the case. It's not a bond, right? So generally there's less liquidity. Or if you invest in one of our non-traded REITs or non-traded BDC or our private equity vehicle, you are trading away some level of liquidity. So again, nobody would recommend you should put 100% of your assets. But if you're an individual and you have a duration, this is for your retirement well out in the future, then isn't it prudent for you to take 10 or 20% of your assets to do this? Or back to my example of an insurance company, couldn't you, since your liabilities are so long, if I could get you 225 over versus 60 over in terms of a spread by helping you make a loan to a data center or energy project or whatever it else, shouldn't that make sense for a portion of your portfolio? So the short answer is some liquidity trade-off is what you're giving up. And the benefit is higher returns. So you should modulate that to your own liquidity needs.
So be a fortune teller for a second. It's grown remarkably, private equity. How far can it go? I mean, you talked before about some people having 0, 1, 2% allocation and go up. But how big can this thing get? Can it continue at this rate of growth, private?
Well, I think it'll be varying. I think things like private equity may not grow at the same pace, but private credit, I think still very early days, back to my earlier comments about the penetration being very low. I think back to the individual investor, $80 trillion of wealth, people who have $1 million or more of liquid assets globally, about 1.5% allocated to privates. Could that be a lot bigger? I think the answer is yes. So what's fascinating is I travel a ton. So I was in Europe the last 2 weeks. I'm going to be in Australia next week. When I talk to clients around the world, other than a handful really of corporate pension funds who are fully funded and are generally saying, I just want to stick with my liquid fixed income, almost all the clients we speak to want more exposure to private assets. Now, in some cases, you know, they have private equity exposure. They haven't gotten money back as much as they'd like, so they're at their caps. So there are constraints. There may be geopolitical things why they aren't doing it. But in general, when I meet with clients, they're looking for more. So it still feels like a long-term, very positive, good neighborhood from our perspective.
You mentioned systemic risk, as I recall, it was like maturity, liquidity, and leverage you talked about. Is there another that you could think of as a systemic risk, which is opacity? It's not as transparent. I mean, it doesn't give Jay Powell or Scott Bessent as much immediate feedback on how the economy is doing. Even right now, we can look at it. The economy is, to some extent, slowing. We don't know how much, but to some extent. Is it possible we don't know how fast because a lot of it's tied up in private?
What's interesting is if you look at the public markets today, the stock market, market cap, and the bond market are both about double where they were a decade ago. So there's still been pretty good growth in our liquid markets. I think their data collection because of AI is getting better and better. I still think there's a lot of tools out there to see what's going on. And again, I think from an opacity standpoint, what are we getting at? We're getting at risk. Is there a bunch of leverage or something building up in the system? And that's just not what we see. And again, in the private markets, it's very hard to do it. Remember, a bunch of this also is moving from bank balance sheets. So maybe you had some look, but in general, in the financial reporting of banks, it's hard to know exactly all the consumer loans, this sort of thing. So I would say the benefits to me greatly outweigh the costs, because by allowing more capital to get into the system, you're generally bringing down the costs for consumers and businesses. And if you contrast it, let's say, to Europe, which relies primarily on its banking system and one pipe, basically, as opposed to the multiple pipes, and I think that will change over time. But I think when you look at that, I think this is really a positive.
So you're known at Blackstone, I believe, for thematic investing. You have certain themes, things like energy, things like data centers, certainly real estate for you, AI. What are the themes you're really focused on right now? And as important as that is, are some going up and some going down? Are you readjusting?
Well, you have to constantly look at this, because what is a great neighborhood today can change when technology changes or the prices get too high, there's too much enthusiasm. You touched on them, David. So I would say we continue to like digital infrastructure, the data centers, because despite DeepSeek, or maybe even because of it, you're going to drive down the cost of compute, and I think drive up the usage. And so people are very worried about, is there going to be the need for all these large language models? And maybe there's need now instead for more training. But it just feels like as our lives move online, as there's more digitalization, as there's more data that needs to be stored, more driverless cars, I think these data centers remain the sort of physical manifestation of where the world's going. And for us, we do it in a very disciplined way. We don't build these things until we have a long-term lease. And then off of that trend, of course, the energy and the power, which is related to data centers, it's related to reindustrialization, it's automation. I just think there's a huge need for electricity. Basically, power demand in the US was flat for 25 years, and now it's going to grow 40% projected over the next 10 years. So transmission, generation, including renewables, utility services. I'd say life sciences is another area. Again, the technology is going to accelerate what's happening there. And so investing in buildings in places like Cambridge, Mass, companies that run trials of new drugs, and then the phase 3 drugs themselves. I would say geographically, a place like India for us is very exciting. We just celebrated our 20th anniversary there. The physical infrastructure improvements, the capital markets, legal, a pro-growth government, a lot of entrepreneurial people, rising middle class, very exciting. I love our alternatives business, stakes in other managers, secondaries, direct lending. Commercial real estate has had a very tough run. The prices have fallen, new supply's down. This is the time to do this. And so for us, it's identify a few of these thematic themes and then try to capture it in private equity, in infrastructure, in real estate, in credit, where you sort of flood the zone and try to produce an outsized return. And I think too often as investors, there's so much focus on page 58 of the memo, back to our memo discussion, and the footnote there, as opposed to what is this big trend that's happening? Now, you can overpay for a good neighborhood, a bad business in a good neighborhood, or pay too high a price. But in general, if you sort of fish where the fish are, your chance of success is much higher.
So I want to come back to a few of those subjects. Let's start with data centers. And I don't want to lose something you said, but I want to emphasize it. I think you said you do not build them unless you have a long-term contract. So you're not building it on spec.
These are not Miami condos.
Yeah, exactly. Yes. But do you still have the same line outside your door to enter into those long-term contracts? Because there's been an awful lot of money that's been put into this.
What's interesting is, and we own a number of very large companies. We're the largest investor in the space globally. We have $80 billion of leased data centers. There's still tremendous demand from the underlying large, mostly hyperscalers, the biggest tech companies. So the demand for now has continued to be very strong. It may shift in terms of who the players are. Do more individual companies, enterprises show up, new players? There's obviously a lot that's dynamic happening with OpenAI and Microsoft. But in aggregate, I'd say the demand for space and for data centers continues to be very strong.
Do the economics of data centers change depending on what, goes on in Washington with tariffs and various relationships and things? Because you have to import things, there's all sorts of stuff. It can be just basic materials like steel and things. Prices go up, not to speak of microchips.
It could definitely impact the business. I think what's probably will have a bigger impact is where things settle in terms of who can own these data centers and who can own certain GPUs in which countries. That, I think, will have a very profound effect. The Biden administration spent a bunch of time at the end. I think we'll have to see where this administration lands. So yes, the tariffs can have an impact. What happens geopolitically can have an impact. But to me, I go back to that underlying demand and this movement online and what's going to happen with AI. And that's why I think the demand will probably keep going.
So let me see something AI and connect it up with life sciences.
Yeah.
What does that potentially do to investments in life sciences, the possible applications of AI?
I think, look, I mean, if you think about healthcare, it's so complicated and there's so much data. But shouldn't these machines certainly be able to read an X-ray, with a higher degree than a human being? Shouldn't they be able to take all the DNA of the people who've gotten a certain type of cancer or heart disease, and based on your individual genome, be able to prescribe something that is very targeted? And so I think it's probably the most exciting thing in a lot of ways, where we could extend human life because we become so much more knowledgeable, as opposed to going to a doctor who says, well, maybe you should take this or that a machine based on tons and tons of data sets can do this. Now, it's very complex. The stakes are high, but I think this is an area where the machines can do really powerful things, but also test, in some ways synthetically, and come up with different proposals. Maybe this combination of therapies will work better with this individual person. So I think that's an area we'll see a lot of innovation. And I think it could have a really fundamental change on longevity.
They would take away my journalism card if I talked to John Gray and didn't talk about real estate.
Okay.
You're sort of known, you're identified with real estate. And by the way, data centers are in part a real estate play. But what about good old-fashioned commercial real estate? Have we seen the bottom? Where are we?
Yeah, we've definitely seen the bottom. The nice thing about commercial real estate, it's a pretty simple business. It's supply, demand, and cost of capital. And the demand, actually, other than the office buildings who got hit by remote work, has generally been pretty steady throughout. Economy's grown, so demand for apartments has been pretty good with new jobs. Demand for logistics, particularly with the movement of goods to e-commerce, it's been pretty good. So that's been steady. Supply has really gone down dramatically. There's been a 2/3 decline in new logistics and rental housing, which are our big areas. So as you look out over time, that's going to be very supportive of cash flow growth. And then the cost of capital was the real shock in commercial real estate, right? The Fed taking rates from 0 to 5.5%, spreads going out as people got very nervous. They didn't want to lend to commercial real estate. But I'd say in the last 18 months, borrowing costs have probably come down about 40% between base rates coming down and spreads tightening. And so you're now in that period like you were in the early 90s or after the financial crisis, where people have taken a bunch of losses in real estate. They're very cautious about the sector, but the prices have readjusted. And so if you deploy capital now, you'll generate higher returns. It's a cyclical business. And so you see us deploying a lot of capital.
Well, I wonder about that because when it all hit, the higher interest rates and a lot of people were bottom up, basically, it was speculated there'd be a lot of bad loans that would go bad, a lot of shakeout, a lot of restructuring. Funds were raised, billions of dollars of funds to take care of that. Has that really been expressed? Has that actually happened? Have we worked our way through the bad loans?
Not really in real estate because, again, going back versus the financial crisis, the leverage was much lower. So going into the financial crisis, real estate was probably 80%, 75% leverage. Now it was 50, 60. So away from the office buildings, the people who suffered were the equity holders. And in most cases, the lenders are going to get repaid in full. In the office business, because people stopped going to work and then there was more of a focus on the capital intensity, the values fell very sharply. And that's the one place where you've seen pain, where lenders have taken losses, where there are some distressed sales. But I would not be holding my breath really away from office buildings for a bunch of distressed real estate sales.
Does that include offices in San Francisco, just to pick a city,
Yeah.
or New York or Chicago for that matter? Because they got hit particularly hard.
Yeah, I would differentiate. I would say we're probably most focused today on New York and San Francisco. New York, the strength in financial services, obviously people starting to come back to the office, and the fact that there's no new building. We just announced a large deal on 6th Avenue that we were buying. I've talked about San Francisco publicly. Obviously, that city's been through a very difficult period. I think the mayor there now is very focused on public safety and economic growth. And again, tying back to technology and AI, it is housed in that city. If you could buy a reasonable quality building. If you were a public stock market investor, I think in dollar terms, India, after the US market over the last 20 years, has been the second best performer. So it's been on an upward trend for quite some time. I think most investors are underexposed. As I said earlier, there's a whole confluence of factors. There's also a bit of supply chain diversification, given the geopolitical dynamic that India is benefiting from. But if you look at its GDP per capita, I think it's around $3,000, so it's still a fraction of China, forget Western Europe and the United States. And sort of embracing capitalism. There are a lot of very interesting companies there. We have, as I've said, focused a lot on the rising middle class, travel businesses, healthcare businesses, financial services. We're also increasingly looking at some of their export companies. I think it's got a long run. And I think this is a neighborhood that we can be talking about. Doesn't mean the Indian stock market can't get too enthused. And this year it's had a very tough run. But I view that as more temporal. Long term, I think it's a country that should do quite well.
Talk about Europe, because a lot of people have said on Wall Street for a while, Europe just is not a good place to look for investment. There are a lot of changes that are coming, in part precipitated by the new Trump administration. But around Ukraine, the spending on defense, Germany really taking a remarkable shift in its stance on borrowing. Does it make Europe more investable?
You know, it's interesting. This has obviously been, the change in policy has been very tough. As I said, I was in Europe the last couple of weeks, and there are a lot of questions, concerns, uncertainty there. And my hope is that there will be negotiations and settlements, and we'll get to a mutually beneficial spot. I would say, I think the silver lining is that I think the European economies, I think it's going to happen globally, are looking at the balance between sort of regulation, taxes, and growth. And I believe, particularly going back to the financial crisis, through COVID, the emphasis has been on prudential regulation. And by the way, regulation is super important. Nobody wants consumers or businesses to be defrauded. We want transparency in all of this. But when you think about the Fed, it has a dual mandate. It's price stability and employment. And I think a little bit in Europe, that was regulation, which is so much focus. So it's very hard to build housing. It's very hard to get energy. It's hard to start a business. It's hard to access capital markets. It's hard for us to, do things with our private capital products there. The amount of rules, bureaucracy has inhibited their growth. And they've got an enormous number of very talented people who are there, highly educated. And the one thing that may come out of this, as I said, as a silver lining is, I think there'll be a focus. And you're hearing this from different administrations over there. Certainly the UK is talking a bunch about this now. How can they sort of re-energize their own economic path? The Draghi report talked about this. And as investors, again, stepping back, these currencies had weakened a ton. Their stock markets traded at multiples that were a fraction of the US. And there was a little bit like it's not worth it. And it's possible through all of this, although there certainly will be some headwinds from tariffs and other things, that they may do things that re-accelerate growth. Some on the regulatory front, and then as we saw with Germany, not only the defense spending, but maybe that they're going to do some fiscal stimulus because they have some room for that. So I think as investors, you want to look at opportunity. It's a bit back to our San Francisco conversation. Investors would have said, forget San Francisco, write it off. Now there's been a change in leadership. There's a new technology and opportunity emerges. And I think there could be some of that. But there are still some long-term structural challenges there.
So talk about growth and productivity in Europe versus the United States, because we've seen that disparity over the last 10 years. The numbers are really quite astounding, in part because of tech, because tech has grown so much in the United States. One of the things in the Draghi report you talked about that I had not focused on is the reliance in Europe on banks as the primary funding source actually curtails investment in technology because it's speculative, and that having capital markets actually drive that. Can we see a world where actually they would take that on?
It'll be interesting to see. Often the cultures are a little more risk averse, but I do think better capital markets funding. They have banned securitization after the financial crisis because they got badly burned, but instead it should have, I think, moved towards better regulation. I think back to my other comments, a robust private market embracing that could help them. There is a little bit of like Gulliver's Travels, right? All those little things, and you want to come along here, and I think you could unleash something. It's just much harder because you have 29 individual countries, you have Brussels, there's a lot of process. I would say I don't believe it's going to move to where the US is, but the real question as investors is if it starts to move a bit, can it improve? And we've invested in some really great technology companies. We own a business, Adevinta, which is an online marketplace. It's done phenomenally well. So I think there will be opportunity there. It's likely to be a place that grows more slowly than the US and have less productivity, but I think that's more than priced in. And so I think looking in Europe is interesting. And I would draw one analogy, which is what's happened in Japan, which is basically Japan had very slow growth for almost 3 decades. And starting with Prime Minister Abe, continuing through Kishida and the current administration, they said, we're going to make companies start to focus on shareholder returns. We're going to allow foreigners to come in and invest in these companies. We're going to push companies to sell non-core divisions. We just bought a very large $3 billion real estate complex in Tokyo from a railroad company. We're seeing more of those type of transactions. We did a couple of privatizations last year, and they're encouraging their people to go from just being savers. And this is another problem in Europe because of all the regulation, and encouraging them to become investors, investing in a range of things, both domestically and abroad, including private assets. And what have you seen in Japan over the last 18 months, 2 years, is a real revival in their stock market and growth. So there is a model out there for shifting and opening up these markets, encouraging risk-taking, encouraging business formation, capital markets activity. And so that's the sort of thing I'm hoping the Europeans look at and say, I want a little more of that.
Come back to North America just for a minute. We tend to focus on Canada and Mexico right now in terms of trade in goods, basically, but there's a lot of investment as well that's been made across border. How does what the Trump administration seems to be pursuing change that calculation? I mean, you have investments in Canada and Mexico, and that capital integration across the border has been important.
Look, it's a real question. I think it depends on the type of businesses. The focus has really been, as you know, on goods trading, not so much on services. Certainly, a number of businesses we own, let's say in Canada, are in Canada for Canada. I think, you know, as you ponder manufacturing businesses that rely on supply chain going back and forth, and you see how much friction can erupt, you know, can come about, it does have an impact on how you think about those type of businesses. But we're still believers in both of those countries, and we still think the long-term economic prospects are good. And I go back to the tariff diplomacy will settle. These three countries need to get along. We've got to find a way. I think we ultimately will. Maybe the terms of trade in certain areas will shift, but ultimately, there's so much at stake on all sides. So I'm definitely in the camp of let's have a little patience, and as investors, take a little bit of a longer term view, and we continue to do things. In fact, we're working on a number of large things in Canada right now. So I still think those will somehow work out.
And finally, we had some questions submitted from the audience, which I've tried to weave in here about private equity, private credit, regions and things. But one I think was really pertinent at the end here. How do you take into account longer term trends in your investment? And the things mentioned specifically climate and demographics and scarcity of resources. How do those factor into your investment decisions?
Well, I think some of them have real relevancy in the near term, right? So if you own assets on the coast somewhere and there's a higher likelihood of hurricanes and so forth, you have to think about that. If you're investing in the property casualty business and there's a greater frequency of loss, you have to price that in. If you're buying certain assets in Europe and you get a lower cost of debt because you get a benefit because this is a greener asset, you can factor that in. So there is, and there's also a liquidity factor. Today, obviously, it's generally easier to sell green energy assets than it is hydrocarbon assets. So I'd say there's an immediacy that you're factoring in. The longer term sometimes is harder, right? I mean, certainly around climate because it plays out over a longer period of time. And it's something we're thinking about. I'm not sure it's immediately when you're thinking about a 5-7 year impact of an investment. I do think population is really important. I mean, if you look in the United States, the shift moving southward is pretty material and continuing. What's happening in Texas and Florida and Georgia is very different than what we're seeing in the Northeast and the Midwest of the United States. And it'll not only have political impacts, but if you own businesses, particularly big infrastructure businesses, and there are less people, or big real estate assets and there are less people, you have to factor those things in. And so you love to be in a place that's a good neighborhood that generally has a growing population and a growing economy.
But let me push you just one step further than that. Globally, if you look at the replacement rate for rates of birth in Japan, in Korea, in China, in the United States even, and in Europe, basically we're not going to be replacing our workforce. How do you take that into account for the long term in your investment?
Well, it's interesting. In Japan, our biggest investment sector by far is healthcare. And our other biggest would be travel, people visiting Japan. And yes, you're taking into account that particularly outside of Tokyo and Osaka, you have declining population and not really a long history of immigration. The saving grace for America has been that by adding to the population legal immigration into the country, a growing population, that has enabled a certain level of growth and also supports people as they retire. I think it is a long-term challenge. It's a near-term challenge, certainly in Japan and some of the European countries. And it's something, that's going to have to be addressed. Now, the balance has been, we've seen immigration policies in Western European, US, Canada, Australia, that maybe didn't necessarily match up with exactly what the domestic populations wanted. And so I do think there's going to have to be a balancing between the long-term needs of population and how quickly it happens, and does it happen in a legal structure. So I think population demographics very important when you're deploying capital, particularly on longer holds.
So John, let me finish where I started. It is truly a pleasure to talk to you anytime, any place. Thank you very much. Ladies and gentlemen, John Gray of Blackstone.
Thanks. Thank you, Dave. Yeah.
Thank you both for your time today and for such an insightful conversation. I am happy to share a few of our upcoming events and hope that you're able to join us. To close out the month next week, we have a webinar with Bill Gates on the 27th for our author series. And looking ahead at April, we have another full month featuring speakers such as Mohammed El-Arian, Larry Fink, Austin Goolsbee, Darren Asamaloglu, and Dan Loeb. We encourage you to mark your calendars and join us for these exceptional programs. Before we close, I would like to recognize those attending from the nearly 400 Centennial Society members whose generous contributions continue to provide vital support to the club's mission. Thank you for your unwavering commitment.